Did you know that consumer prices climbed 7.5% over the past year, the quickest pace of increase since 1982? Inflation is real, and the Federal Reserve is preparing to take action. The federal funds rate, currently set at 0, is expected to be increased multiple times throughout 2022. What does that mean for your portfolio? Let's dive right in. When you're expecting rates to rise, the first step is to review your asset allocation. Rising interest rates make it more expensive for both consumers and businesses to borrow money. For this and other reasons, rising interest rates can increase market volatility in the short term. Not all sectors are impacted the same, however. While many companies in a few specific sectors may have thrived in the past several years during zero interest rates and very tame inflation, a different group of investments tend to perform better when rates rise and during periods of higher inflation. This is why it is important for investors to remain diversified and to rebalance their portfolio on a periodic basis. Next, interest rate hikes are a good reason to examine your personal debt. If you have variable rate debt, such as credit cards, a home equity line of credit, or an adjustable rate mortgage, refinancing these loans at a lower fixed rate before rate hikes begin may be greatly beneficial. Prevailing rates are still historically low. By doing so, you can keep rising rates from negatively impacting your cash flow, and you can keep more of your investment dollars working for you rather than needing to divert assets to make increasingly higher interest payments. Bonds are traditionally known as a safe haven asset, as they provide a relatively predictable stream of income and can act as a portfolio stabilizer, helping smooth out returns during periods of higher volatility. Bond prices tend to rise when interest rates fall, but can increase declines when rates begin to rise. There are bonds that can benefit from periods of rising rates and higher inflation, but you would be wise to consider rebalancing your portfolio to ensure that your portfolio is positioned appropriately during this time. Market volatility is financial jargon for a period of time when portfolio values are rising and falling. We started to see volatility pick up in late September, and it continued through the end of the year, leading to a market correction in January. A correction is when the price of an asset falls by more than 10%. While it's certainly not fun to watch your account balance drop in value, corrections are actually quite normal, as they occur on average every 12 to 18 months. As a matter of fact, we have experienced 59 corrections in the past 76 years. While no one can perfectly time the market, and we certainly can't control financial conditions, we can control how we respond. If you're a long-term investor, corrections provide an excellent opportunity to add to your account when prices fall. Since it's extremely difficult to know exactly when the market will stop falling or when the news cycle will improve, we recommend that investors add to their accounts on a systematic basis as often as possible. This helps reduce anxiety over current conditions and helps smooth out your returns over time. It can be difficult to invest when the news is unsettling. In fact, it's a perfectly natural instinct to want to hold on to cash and wait until things settle down. Be aware, however, that by the time this feeling fades and market concerns subside, market prices always tend to be much higher. If you follow this instinct, you will give up the opportunity to invest on sale, and unfortunately will end up paying full price. So remember, each account has its own time horizon, based on the goal you're funding for. If you're saving towards a goal that is many, many years away, prices in the short term become much less relevant. Remember, a proper financial plan is designed with your long-term goals in mind. Your plan may already take the possibility of rising interest rates and higher prices into account. But if rising rates or inflation are on your mind, or if you'd like us to review an account that we don't currently manage on your behalf, let's talk. We'll be happy to schedule a call or a virtual meeting to discuss your concerns and to help ensure that you are well positioned for the changing environment.